right, notwithstanding this little dip here we've seen at the open, but are we in silly season or not? What needs to go right to ratify this move?
I mean, this has been an all-year phenomenon, right? I mean, we're sort of seeing a little bit of icing on the cake. It's definitely a liquid, but the theme is the theme. The theme is that the Fed is very much on hold next year. The Fed is much more likely to ease than tighten. They've laid out, I think, a pretty good roadmap for us on interest rates at the short end. They want to change their inflation targeting regime sometime after next year, probably, which is very, very bullish for the short end of the fixed income markets. I think there's a nice setup here. You've got your trade and your Brexit out of the way, a lot of uncertainties, but really the interest rate landscape looks pretty favorable for stocks and really pretty favorable for multiples. So I don't see why the grind doesn't make sense.
Does that story get extended as we get some rotation in voting members? Does it get more dovish?
I don't think the rotation's going to matter that much. The president's, as much as I love to hear from them all the time, it's the core of the board that really matters. It's going to be the vice chair, the New York Fed president, and Jay himself that are going to guide everything.
Are central banks, or I guess is the Fed more likely or less likely to make any kind of changes in an election year?
Much less likely. I mean, it's just, if they can hide behind the curtain and just sort of pretend they're not there, they would love to do that. The less tweets on both sides. If the markets get rattled, if things, whatever geopolitics spikes up and they get forced into or think about cutting, markets are going to talk about them being political again on the other side. So I think they have to be, the bar is pretty high on both sides, but it's much higher for a hike than it is for an ease.
Jurrien, you've been pretty constructive. Is your appetite sated given the last 11 sessions?
Well, as you know, the fourth quarter of this year has been a mirror image to the fourth quarter of last year. And the decline last year was exaggerated because of the lack of liquidity. And I'm sure we're seeing the reverse of that, this year. So maybe we shouldn't be going up quite as much. But, what is clear is that markets at inflection points, the PE ramps up first in anticipation of an earnings gain down the road. And when we look at 2020, obviously that earnings gain needs to happen or the market is out over its skis. But my sense is that it will happen. And so maybe earnings are up, 7-8% next year, not quite the 10% that are expected. You add 2% dividends and you still get a pretty good outcome for 2020. I remain constructive. I think the rotation that is underway out of bonds into stocks, out of large into small, out of growth into cyclicals, although certainly growth stocks are doing very well as well. I think that lasts into next year, well into next year, and EM probably could be the shining star, sort of like it was in 2017. But all in all, this market continues to behave exactly like a secular bull market. And I want to respect that because often what the tape is doing is as important as what we all think it should be doing.
Yeah, Jurrien, just to dig into that a little bit more, I mean, your recent note, you talk about the mid-cycle adjustment analog of 95, 98, and 2011. That continues to track perfectly. If that's the case, what are your expectations more specifically in 2020?
I think an up market. So if you take... So right now, earnings expectations are $175 off of a base this year of $161. That $175 probably comes down a few dollars because that's what typically happens. But even if it does, you're getting about 7-8% earnings growth, again, 2% dividends. If the PE gives back some of the ramp that we're seeing this year, which is likely because expansions in the PE multiple take turns with growth in earnings just because markets are discounting the future, especially at turning points. So when you add it all together, I could still see a high single-digit year next year, certainly not the 30% that we're seeing this year. It's amazing that 2019 actually is shaping up to be an even better year than 2013, which was a 32% year. And for this to happen in the 10th or 11th year of a secular bull market is really pretty impressive.
David, if I could turn to the Fed for a moment.
Sure.
We were talking earlier about this non-QE, but what adding to the balance sheet at the tune of about $101 billion a month for the last 3 months. Educate us. What does it mean? A lot? Not much? What is it doing, if anything?
I think, David, you can actually point from July when we first broke out to those new highs and took out 3,000 in the S&P until mid-October, we kind of went nowhere I mean, we bounced around. We had a little sell-off in the summer, came back. And then all of a sudden, the Fed announced this non-QE in the middle of October, and the ramp really began. I think you can correlate it pretty well. So I do think a lot of this liquidity add and this commitment to making sure that there are reserves in the system, nobody is going to see short-term interest rates get out of the control of the Federal Reserve, is really adding some short-term fuel to the fire. And it's a big deal. It isn't easing. It is like cutting 25 base points. This is QE. No matter what they tell you, when you add reserves to the system and you extract securities, I don't care what the security is, you are easing. You are creating easier financial conditions. You can go back to Ben Bernanke's original piece on QE back in 2009 before they did it, where he was trying to discuss credit easing versus quantitative easing. This is QE. They don't want to say it because they're a little afraid to kind of say that they're really easing aggressively, but they're doing it for the money markets, but there are side effects and consequences. And this is a lot of what I think is behind the ramp, but I also think they're supposed to be in a way. I mean, we've had undershoots in inflation now for 8 years. They kind of over-tightened last year. We got the 3 cuts. We're still not getting the inflation anywhere near target. So
except in asset prices. Yeah,
but asset prices are not the CPI. This is, we could have a long discussion about this, but that asset prices are the way we get consumption tomorrow or in 10 years. Okay, what people really want is to make sure their 10 and 20-year horizons are covered. They're not interested that much in their current consumption ramp up. And that's really what we've seen the whole time. And a lot of that actually is less about the Fed and more about demographics and longevity, which is another session that we could spend a lot of time here talking about, which I love to talk about, but
we should do a special on demographics the world over, by the way.
And longevity as well, and aging, because people need that consumption in the future much more than they need it today. And that's driving asset prices a lot more than Fed policy, in my opinion.
Jurrien, do you agree, especially where the Fed's operation in the repo market is concerned? And if so, how supportive is it to equities?
Yeah, I think if we can sum up the key story for 2019, it was that the bond market put the Fed on notice via an inverted yield curve that the Fed was too tight. And guess what? The Fed listened and cut rates 3 times pretty quickly and went from shrinking the balance sheet to expanding it at a rate much faster than it was shrinking it before. And so, when you look at what ends bull markets historically and what kills expansions, it's sort of a tone-deaf, or maybe not a tone-deaf, but a central bank that commits a policy error, either for justified reasons or not. And this year, the market sensed the message to the Fed through the curve, and the Fed responded almost immediately. It may not have wanted to, but it did, and to its credit, it kind of saved the day, if you will. So I do think that the Fed has been a very important player, and also promising to not tighten unless inflation really starts acting up. Almost by definition, if we're seeing some sort of global recovery, even if it's a muted one, if the Fed stays where it is and the economy expands, and therefore the neutral rate, R star, goes up, then by definition the Fed is going to be more dovish next year than it is this year, even if it doesn't cut rates at all. And I think that creates a very bullish backdrop for the stock market and other risk assets. And you're seeing it with credit spreads. And again, liquidity is part of that story, but definitely that's a very big part of the story. So I agree with your other guests.